Hello learners, welcome to our third lesson under capital budgeting. Today we are going to study capital budgeting techniques under certainty. Capital budgeting techniques under certainty. Capital budgeting under certainty. Okay, capital investment decisions under certain conditions. That is our topic today. Our lesson. Remember last time we defined what we mean by certainty. Certainty is where the investors are aware of the dynamics, the market dynamics, like investment opportunities. This is where investors are aware of the prevailing opportunities to invest, where the investors are aware or they know the cost of capital, and they are aware of returns expected from projects. So today we'll be looking at the techniques that can be used in evaluating projects, techniques or methods or tools. We'll be studying the tools or techniques or methods, all right, or methods that can be applied in evaluation of capital projects. And the investment decisions regarding our projects are concerned with the profitability and selection of a project. And remember, in our last lesson we mentioned that investment decisions involve new projects or new investment. They also involve replacement and many other aspects we discussed in our last lesson. So when appraising or evaluating projects in capital budgeting, and in view of the significance of capital budgeting decisions, it is appropriately necessary that the method adopted for appraisal of capital investment proposal is a sound one. It has to be sound. The technique or the tool or the method to be used in appraising any proposal has to be sound. And how do we measure soundness of a technique? Because there are many techniques which we are going to discuss, but whatever technique is adopted has to be a sound one, all right? Because remember, capital budgeting involves investment of a lot of money, so you need to have a sound technique that will enable you make the correct decisions. So, and any appraisal method should provide the following. Okay, how do we measure soundness? I'm saying soundness can be determined on the basis of many factors, which include, number one, a basis of distinguishing between acceptable and non-acceptable projects. So the technique to use should be one that enables you to select. There should be a selection criteria. There should be a selection criteria or a decision criteria that you need to base on your decision of either accepting or rejecting a project. So there should be a basis of distinguishing between acceptable and non-acceptable projects. Number two is ranking of projects in order of their desirability. So the technique that is to be adopted should also, the technique that ought to be adopted should be one that can rank projects in order of their desirability, so that if you have several projects, like say project A, project B, project C, project D, the criteria that you use, the technique that you use should be able to rank these projects. There should be ranking of projects. The method should be one that enables ranking of projects, so that project A may be ranked number 3, project B ranked number 1, project C ranked number 2, and the other one number 4, for example. So the criteria should be able to rank projects into the order of desirability. So that is an important factor. Number 3, choosing among several alternatives. The criteria to be chosen should be one that enables the decision maker to choose among alternative projects. Number 4, a criteria which is applicable to any conceivable project. Number 5, recognizing the fact that bigger benefits are preferable to smaller ones, and early benefits are preferable to later ones. So, and again, there are many projects. I mean, there are many techniques. There are many techniques or methods for evaluating and ranking capital investment proposals. In all these methods, the basic method is to compare the investments in the projects regarding the benefits to be derived. In all these methods, the basic method is to compare the investments in the projects regarding the benefits derived. So those are the features or qualities of a good or sound technique. All right, the technique you adopt should bear the features that I've just mentioned. So remember, we are talking about capital budgeting techniques. Capital budgeting techniques. Capital budgeting techniques. And there are two. These techniques can be broadly categorized into two. Number 1, we have the traditional methods or techniques, and modern techniques or methods. These traditional methods can also be referred to as non-discounting methods or techniques. And the modern ones can be also, you can also refer to them as discounting methods or discounting methods or techniques. So there are two broad categories of capital budgeting techniques, two broad categories, and there you have it: modern or traditional. Traditional, also known as non-discounting methods or techniques or tools. Modern, also known as discounting methods or tools. Now, under the non-discounting methods, we will consider we will consider two methods. We look at two methods, and that is number one, the payback period method. Payback period method and the accounting rate of return. Accounting rate of return method. So there are two methods we will discuss under the non-discounting methods. That is the payback period, also known as or abbreviated as PBP, payback period, and the accounting rate of return, abbreviated as ARR, accounting rate of return. So there are two methods that we will discuss. Then under modern methods, we will consider several methods here. Number one being the net. We have the net present value method. The other one is the profitability index method. Then lastly, the internal rate of return. So we have the first one, net present value. Number two, profitability index. Number three, internal rate of return. So these are the methods that we'll discuss, and the net present value can be abbreviated as the NPV, profitability index as the PI, and the accounting internal rate of return abbreviation is IRR. So these are the methods that we will discuss in this class. That is number one, payback period. Number two, accounting rate of return. Number three, net present value. Number four, profitability index. Number five, internal rate of return. And the abbreviations are PBP, ARR, NPV, PI, IRR. So these are the techniques that we'll be using. We have they are called capital budgeting techniques or tools or methods. Okay, appraisal. We use them in appraising projects. And before this, I had just said there are certain features that are important that should be considered before deciding which criteria, which technique to employ in evaluation of capital investment projects.